Welcome to the second mini lecture in Chapter 9, and this deals with 3 methods we're going to learn to calculate depreciation expense. Let's do a quick review though. If you remember from Chapter 4, depreciation expense is the allocation of depreciable cost of a long-lived tangible asset, not land however, over the productive lives of those assets using a systematic and rational method. We're going to learn 3 of those methods. So we take the asset's cost and split it up over the useful life of that asset. Depreciation expense is the account on the income statement. That represents the wearing out of that asset for just the current period. Accumulated depreciation, the contra asset account that we use, contains not only this year's current depreciation, but it includes the depreciation of all prior periods. And here's the journal entry you learned in Chapter 4. We debit depreciation expense, and we credit the contra asset accumulated depreciation instead of crediting the asset directly. And then we use the accumulated depreciation account to subtract from the asset on the balance sheet. Why do we do that? First of all, it's an estimate, and we may have to correct that going forward. It's not an actual wearing out or using up, as we can count supplies to see what we used up or the number of months that insurance premiums have been used up. This is a lot less accurate. It's simply an estimate. But secondly, we like to show that information on the balance sheet. What the original cost was, less how much we've estimated it's used up so far. And I know it's morbid, but the way you can remember the order of these accounts is it spells dead, D-E-A-D, and as we use up an asset, it dies. Now, in order to calculate that amount, that estimate for depreciation, you need 3 pieces of information. You need the asset's cost. That's all the costs that you capitalized, all those costs necessary to acquire and prepare it for use. You also need an estimate of the useful life, and that's the economic life the company plans to use it for. In other words, how long do you expect to use it? And remember, land is the only tangible assets that assume to have an unlimited life. It doesn't depreciate, so we won't be depreciating land. And the third is the residual value, sometimes called the salvage value or the trade-in value. And that's an estimate of how much that asset will be worth when you're done using it at the end of your expected useful life. Now, this is the important idea behind depreciation. The basic idea is to match the economic benefit that will be used up. Remember, expense or used up benefits, to the periods that the asset will be used to help you generate revenue. Now, so a couple of definitions. Depreciable cost. Up here we use the word depreciable cost, allocating or splitting up the depreciable cost. That's the amount you want to depreciate. It's the original cost less the residual value or salvage value. We don't want to depreciate that portion because we think that that's how much it will be worth when we use it up, when we're done using it, I should say. So residual value is the value that that asset has when we're done using it. So we don't want to depreciate that portion. The depreciable cost, the amount we want to depreciate, is the asset's cost less the residual value. The book value, sometimes called the carrying value of the asset, is the cost minus how much we've depreciated so far, the accumulated depreciation. Okay, let's flip the page and let's look at some methods to calculate those estimates. There's 3 methods we're going to learn: straight line, units of production, and declining balance. Let's start with the straight line method. With this method, you get the same amount of depreciation each and every year. So if we're trying to match the usage of the asset with the method, then straight line is good when assets are used evenly because it gives you the same amount of wearing out or depreciation each period. Here's our problem facts. We have a go-kart ride bought January 1st. There's the cost, $62,500. The estimated residual value is $2,500, and the estimated useful life is 3 years or 100,000 miles. Now here are our formulas for depreciation. The straight line depreciation method takes the cost and subtracts the residual value that we set as the depreciable cost, and then we multiply by 1 over the useful life in years. So in our example, $62,500 minus $2,500 in residual value, you multiply that difference, $60,000, by 1 over the useful life of 3 years, and you get $20,000 of depreciation expense each and every year. So each year you would be making this journal entry for $20,000 each and every year. Here's our calculation again. On the income statement, we would show depreciation expense each and every year for $20,000, totaling $60,000 if we added up all the depreciation expense. And that's exactly what we said the depreciable cost would be here. On the balance sheet, after we do that journal entry the first year, we would have $20,000 in accumulated depreciation. So cost minus $20,000 is $42,500 as our book value or our carrying value. In year 2, after we do that journal entry again, we post another $20,000 to the accumulated depreciation account. So cost of $62,500 minus accumulated depreciation of $40,000 gives us $22,500. In year 3, we do the same journal entry and we post another $20,000 into the accumulated depreciation account. And so on the balance sheet, we'll show the original cost minus total accumulated depreciation of $60,000, and we're left with a book value of $2,500. And that matches with what we said was the residual value. That's the portion we said, don't depreciate that. That's how much it'll be worth at the end of its life. So because we subtracted it out here, that's why our residual value is left here as our book value at the end of its life. With the units of production method, this is used for assets that we do not use evenly. We may use them more in some years than others. The formula starts the same, cost minus the residual value, but then we take this year's actual usage or production and divide by the total lifetime usage or production, and this is an estimate. And that gives you depreciation expense. So the amount of depreciation expense is based on how much you used it. The only thing that changes from year to year in this method is the actual usage. The cost, the residual value, the lifetime estimated usage remains the same. Just this year's usage changes. So then on our income statement, as we do our journal entry, this journal entry year to year, these are the amounts we would use each year on our income statement. On our balance sheet, as we post those journal entries, our accumulated depreciation account, when we do the journal entry for $18,000 the first year, is $18,000, and we would take our cost minus the accumulated depreciation to show our book value. If we do the entry the second year for $30,000, we would post that in the accumulated depreciation account, and the total accumulated depreciation would be $48,000. Cost minus accumulated depreciation equals our book value. And finally, in year 3, the depreciation expense is $12,000, and now the total accumulated depreciation is $60,000. Cost minus accumulated depreciation gives us our book value at the end of year 3. And our book value, again, is equal to our residual value because we subtracted it out from our calculation. The only danger in this method is that you may depreciate the asset too much if you depreciate it, if you use it beyond its estimated total production. So you have to stop depreciating when your usage gets up to or totals your lifetime estimated usage, in this case, $100,000. Our last method is a little different. It's the declining balance method. And instead of taking the cost and subtracting out the residual value, it's cost minus accumulated depreciation. You should star this or highlight this, circle it, whatever you have to do to remind yourself of this, because often this is where students make a mistake. You then multiply it by 2 over the useful life in years to arrive at your depreciation expense. This method is used for assets that are used more in the earlier years and therefore wear out more in the earlier years as opposed to later years, and it gives you a larger depreciation expense in early years than later years. So in our example, cost $62,005 minus no accumulated depreciation at acquisition times 2/3 gives us $41,667 as our depreciation expense in year 1. That's on the income statement. In year 2, our calculation is cost minus accumulated depreciation so far, or $41,667 times 2/3. The second year is only $13,899. In the third year, $62,005 minus the 2 years of depreciation thus far, $55,556 times 2/3 would give us $44,629. The problem with this method in its last years would be that it might add up to more than you want to deduct for depreciation expense. Because if we were to follow this through and do our journal entry for $4,629, our accumulated depreciation would be higher than we wanted it to be. We wanted it to be equal to the depreciable cost of $60,000, and that would give us an ending book value lower than we wanted. We wanted this book value to be equal to the residual value in its last year, and $2,315 is lower than $2,500. So in its last year, just plug in the residual value that you want and find the difference, the amount you need to depreciate to get the book value to equal the residual value in its last year. So $6,944 minus $2,500 is $4,444 as the third year's depreciation. Then the cost minus the total accumulated depreciation, those three added up, is $60,000, and you forced your book value to equal your residual value in the last year. Now let's look at a summary of the depreciation methods, and I'm going to take page 406 out of our text here and look at Exhibit 9-4. Now it shows in blue straight line depreciation being exactly the same each year. Units of production method is going to vary based on usage. And declining balance methods in orange starts really high and then it decreases year by year. But notice that the same amount of depreciation is calculated in total for each of the three methods. If we look back at our examples, the total straight line depreciation expense is $60,000. The total units of production depreciation expense is $60,000, and the total declining balance depreciation expense is also $60,000. So all three methods gives you the same total depreciation. Let me scroll out there for just a moment. Okay. So partial year's depreciation. What if you don't buy an asset at the beginning of the year? What if you buy it midway through the year? Then what we're going to do for both the straight line and declining balance methods is we're going to multiply the annual depreciation by the fraction of the year for which depreciation is being calculated. In other words, the fraction of the year that you used that asset. We don't need to make any adjustment for the units of production method because if you owned it less, you would have used it less. If the asset is purchased before the 15th of the month, we count that full month as if it were used the full month. And if it's purchased after the 15th of the month, then we will not count that month as the asset being used that month. Last issue is tax depreciation. Now, most companies use one method of depreciation for reporting to stockholders, and usually that's the straight line method because it's consistent and even. and a different method for determining income taxes. And because we want the lowest taxes possible, we're going to use the largest deduction and use the method that gives us the largest deduction. Keeping two sets of accounting records like this is both ethical and legal because the primary objective of financial reporting differs from that of income tax reporting. Although the IRS allows a supersized deduction in the early years of an asset's life, it does not allow a company to depreciate more than the asset's depreciable cost over its life. The tax savings enjoyed in the earlier years of the asset's life will eventually be returned to the government in later years of the asset's life. The tax payment that is put off or deferred as a result of taking the large tax deduction for depreciation is reported as a long-term liability called deferred income tax. Now, the IRS offers its own method called MACRS, or the Modified Accelerated Cost Recovery System. Let's try that again. Modified Accelerated Cost Recovery System as a method that you can use for calculating depreciation expense for tax purposes. Okay, now you can take a look at the problem demonstration involving the three methods of calculating depreciation expense.